So today we're going to talk about oil and the real estate market in the city that we live in, Houston. Just some disclaimers. None of the information within this packet is a recommendation by us, or obviously to buy or sell any securities. Information here is general. It doesn't take into account your personal situation. And all the information is taken as of a certain date. So if you come back and look at this next year, it might not be accurate, right? So we're not going to update it. So it's just accurate as of today. And of course, past performance, we're looking at historical data, and that doesn't guarantee what's going to happen today. So just an intro, we're going to discuss the most recent downturn that's happened in the last 22 months or so. We're going to compare it to 5 other downturns that happened in the past 40 years. And we're going to look at how Houston's real estate market reacted in each of those. And then we're going to talk about, is Houston's economy more diversified? And we're going to talk about diversification as far as the oil and gas investments you might hold, as well as the real estate investments you might hold. So the current downturn is very much a result of the increase in U.S. production. U.S. production has increased its supply by 5 million barrels per day, which is a 64% cumulative increase since 2008. A lot of that's because of fracking. You know, the U.S. has been on the cutting edge of introducing new technologies to basically get more oil out of the ground. And the rest of the world over that same time period only increased 2%. So of course the graph shows blue lines the U.S. supply, the rest of the world is barely up. So that in turn, and in combination with the consumption side, there's been some laws that have been passed in the U.S., such as the U.S. Energy Independence and Security Act, that has caused demand to decrease. Demand in Europe and in the U.S. and developing countries is down fairly significantly. It's down 8% in the U.S. and 12% in Europe. And some other factors is, since that's happened, since supply has increased, Saudi Arabia got pissed and said, no, we're going to maintain market share. You guys caused it, we're holding our guns. And they're trying to drive U.S. competitors out of business, which they're doing. And the reason they're able to do that is that their cost is about $10 a barrel, and our cost is anywhere from $30 to $50 a barrel. And I've seen 36 from the source I took. And then
what's the cost of that? Sorry.
For Saudi Arabia, it's just that it's right there, right? I think it's very easy access from, you know.
Yeah, the reservoirs are better charged. They've got better oil.
Different kind of rock.
It's just a lot easier for them to get it up to the ground and to the terminal.
Okay.
So,
Well, how come gas prices are going up? I mean,
They've gone down.
No, they've gone up in the last.
Well, in the last couple of weeks. I mean, oil's gone up from 25 to 40.
I think it has to do with like supply and demand and oversupply. We just have a bunch of it.
And what happens with gas too? Like once the price goes down to a certain level, demand picks up. And another cause is recently we lifted sanctions on Iran, not just the U.S. but the world in general, which caused an increase in supply as they came back to the market. So this next slide, this is what a lot of the people in the industry look to as the U.S. rig count, and it's a little misleading, and I'll explain why. It's good and bad. If you look recently, you can see that the graph has gone, in the most recent area of the graph on the far right, since 2013, you can see a big dip, right? So obviously, U.S. competition is getting weeded out. We're producing less oil. We're trying to cut back on supply. However, if you just look at it since the history, we used to produce. It used to take way more. It's misleading because it used to take way more rigs to produce the same amount of oil because technology has come. So you would expect this graph, in general, to slope down to the right, and that would just be because of better technology. But this most recent dip certainly is because of what's happening with the.
Or when you got laid off, It was just kind of a slow thing. You know, it didn't come up. It didn't really come up until 2001. Wow.
I came right back up.
Yeah.
9/11.
And that's when I graduated.
I've been,
That's when I graduated.
I've been in the industry
2008.
for longer than this graph.
Really?
Okay.
Wow.
Makes you
Why
feel
didn't you go all
old.
the way back, Matt?
They don't have data back
Really, you
then.
barely got.
They were all using-
They wrote things on-
Right, right. They had
These
sticks.
slide cards. Slide rules.
So this shows the periods of decline that we're going to talk about today. The early 1980s oil glut started. The big decline started in the early 80s, which, you know, Steve can talk towards that, I'm sure. Then there was OPEC policy.
You know, it's similar to what we had today. OPEC said they were not going to decrease their output, and we had a corresponding huge decrease in price in 1985.
Then there was an Asia crisis in 1997, 1998. And then there was an early 2000s recession. And then there was the Great Recession, of course, in 2008. The price got up to $144 a barrel, if you can imagine, and then dropped down below 50.
Is that when the housing market crashed?
Yeah.
Everything just.
That was the big one, yep. And then the most recent one started in June 2014 when oil was around 100 and I think it got up to 105, and now it's down to, I think the last time Friday it was 39 something.
I mean, what does it need to be the oil for it to kind of just stay nice?
It's a commodity. It's never going to be. It's going to be volatile. That's why the industry pays so well. It's because it's more risk. They have to pay well for people to stay in it. Because there's going to be times like this, right?
You have to plan for all of that, huh?
Yep.
So what is it every? How many years?
It just depends.
Okay,
You have,
it depends.
I mean, you got.
So this is inflation adjusted. So you can see though, like people that think that commodities are a great investment. I mean, since 1980, this is inflation adjusted. So for example, in 1980, the price wasn't really $100, but if you account for inflation, it was. So it's not a great, I mean, if I just look at this chart, I don't think it's a great investment to hold long term. It certainly diversifies your portfolio and has some other advantages, and it certainly would have had advantage if you bought in the late 90s. But overall, I mean, it's so volatile, and it's lower now than it was in 1980 inflation adjusted. You would have lost money to inflation if you invested in 1980. So this is just a expansion on the graph. This is the data. So the decline has the start of the decline. So our most recent decline started in June 2014, and maybe we finished the decline. Maybe we're back up towards the recovery mode. It's hard to tell. It feels like that. It got down to, like I said, in the 20s. Now we're up around closer to 40. It started, the high price when the decline started was $105. When I did this, the low price was $37.19, and it had a 65% decline. And so the months of decline, 18 months, greater than 18 months. We won't know for sure, obviously, until we're done, how many months of decline we've had. And the recovery is unknown. So the recovery would mean when it gets back up to that high price.
Is there anything that's going to make it?
I wouldn't say it's going to get there. Well, so we'll get to my thoughts on at the end. But for example, the 1980s oil glut started at $115, and it took 312 months to get back up to that price, to that inflation adjusted price. And so you can see sometimes it recovers quickly, other times it doesn't. Like in the 2000s, it got right back up within around 2 years later, it was back up to $46.
Well, what happened in the 2000s?
It's just the market forces. It's just
There's not
supply and demand.
one
Yep.
thing that shows why it went up?
Nope.
Okay.
Too many factors, probably.
Yeah.
How many what?
Too many factors.
Oh,
I mean, if I could tell you why oil's going to get to $60 in 2 months, I'd be rich. I can't.
You would think all the oil companies would say, all right, everybody just stop drilling.
I mean, a lot of them have. I
I mean,
mean,
the demand goes way up, and then everything, and it happens like that. But
the problem is OPEC said nope.
Everybody's trying to
Control
get money for
everything.
themselves, so right now they're wanting to buy low,
The reason why,
sell high when it's going to turn around, because it will.
yeah, and the reason why Saudi Arabia doesn't want to lower prices is that they want to keep market share. They're arguing that with all the supply increase that the U.S. had, they lost a lot of market share to the U.S. So they're trying to keep price where they are, get all these U.S. players out of business, and then their market share is still high. So there's three constraints we're going to look at when we examine each of the 5 cases that we just talked about. One of the things we're going to look at, and you'll see a theme here. There's 3 things that happen, or I guess 4 things. First, oil drops. Then, if that causes, then you look at how long that recovery, if oil recovers quickly or not, and then that will affect employment, which is the green. It will always be green on the graph. We'll see later. And then how does that affect housing? So it's 3 main things. Oil affects employment, affects housing. Okay, it's pretty simple and it's pretty logical, I think. And so the red is just the inflation-adjusted house price index for Houston and the Woodlands and Sugar Land. What? Oh, it's orange. I'm sorry. The orange line is the quarterly inflation-adjusted house price index for the Houston, the Woodlands, and Sugar Land area. And so here again, you can see that we've had a big, if you look from like 2011 to our current situation, we have a big increase in the house market in Houston. And I think we can all attest to that. There's been house prices have increased significantly. But I was surprised that if you look back, again, since 1980, it's actually gone down. House prices were crazy expensive back then. Now again, house prices weren't the same price as they were today. It's inflation adjusted. So a dollar back then bought you less house than $1 today. And a lot of that's because if you would have went back even further on this, both oil and house prices kind of shot up in the 70s to 1980. So you had a huge demand for houses in Houston back in the early 1980s. And then that fell off and prices declined.
Is this just straight like house price, or is it including your?
This is single family homes.
Okay. Well, what I'm thinking is it including your? Oh shoot, what's that? Like the 4.5 or whatever. What is that called? The your loan
Interest rate?
No, so this is just what you purchased the house for.
Because weren't loan interest rates also really high in the 80s as well?
Yeah.
Okay.
Yeah, no,
Like
so
17, 15,
this is,
something.
yeah, I get what you're saying. This is not total cost to buy.
Okay.
This is,
It's just house price.
right, yeah.
So it's kind of going up a little bit. I mean,
Yeah, it's gone up big time here in the last, that's a big percentage jump. But if you look at the tail end of it, it looks like it's kind of leveling out a little bit.
so now it's time to sell your house?
So all that kind of stuff has to depend on where you're going to buy, right?
Okay.
Like if you're going to buy in Houston, it might be a good time to buy in a year, right?
Is interest rates still low? Like they were?
Interest rates are very low. Lowest they've, actually it's the,
What are they?
interest rates right now are probably, they're around, I think I heard 3.6
Oh, wow.
for a 30-year, yeah. And they've gone down in the last 5 months because they spiked up once everyone thought the Fed was going to increase rates, and then of course that market always overreacts to that, always. And so what happens is the rate shoots up, and then reality hits, and Yellen came out and said, no, we're going to do gradual. We've told y'all gradual the whole time. So then it starts to level out, and rates went back down. So it spiked up. It spiked up around December or November when they were going to talk about their first rate increase, and now since then it's gone down.
Wow. So you could get a really good deal.
Yeah.
Good interest and good money. I mean, good price.
But again, so it depends on one, like obviously first-time home buyers might want to wait 12 months, get a house cheap. This is not a recommendation. But in two, like if you're, so think about if you have it's like a starter home, and then you're wanting to move into a bigger house, you can make money on that way too. Yeah, you lost money on your starter home, 10%, but you're buying a bigger house that's lost more money, right? Does that make sense? If you're moving from a $200,000 house that's lost $20,000, now 180, you sell it 180, but you're buying a $400,000 house, that same 10% decline got you 40,000. You're buying 40,000 less. Okay. And then obviously if you're selling, but unfortunately what happens is, you know, people are moving out of Houston. People are forced to sell. So those people are selling low, and the housing market in the rest of the U.S. is pretty strong, pretty robust. They're buying at hard prices. So there's no jobs data available for the early time periods we're examining, but down on the bottom left is just oil price versus housing. Oil is the blue. Again, oil is the blue, and housing is the red or orange colored line that uses the right axis. Oil and housing declined. So, and there's three things I want to focus on, these yellow highlights on the right. Again, we're going to look at how long does oil take to recover, if the jobs year over year increase is negative, so if jobs are contracting, and then that in turn will cause a housing decline. In each one of these cases, those three things have to happen, or those two things have to happen for the latter to happen. So the first one, the recovery on this one took way more than 3 years. It took 312 months, okay? Was the jobs rate year over year increase ever below zero? We don't know because we don't have jobs data. But I can tell you from talking to people in the industry, yes, in the 1980s, Houston's job market was contracting. And housing took a 25% decline back then, which is a lot. From 1985 to 1986, again, the month's recovery was a long time. The jobs rate, we still don't know if it was ever below zero. And housing took another 19% decline over this time period, from 1985 to 1987. In 1997, 1998, the Asia crisis, we had only 13 months before oil got back to its normal price. Jobs rate was never below zero. So now we have jobs data. So jobs are up top. It's the green line on the graph, and housing did not decline. So you can see oil went down. The jobs got down almost to below zero, but they still were like a 1% year over year increase, even at the worst time. And so what that means is that we are still adding jobs to our economy. So housing had no reason to decline. We never went below zero. So housing consistently went up over the same time period. And you can see that oil went down. Like if housing doesn't match, this is what I'm trying to say, oil doesn't exactly match the housing market. Oil can go down, but housing can stay robust if market expectations are for oil to come back quickly, we don't lose jobs, and the big companies are not laying off huge amounts of people, which they weren't during this time period.
These are all jobs, not just oil jobs, right?
These, yes, this is total Houston job market. Yeah, and so that's why we're going to talk about at the end is Houston, because I've seen some articles from some big real estate companies that say Houston's more diversified, and that's part of the reason why our housing hasn't gone down yet. Housing hasn't declined yet; we're still pretty flat. But we'll talk about that. And so in this early 2000s recession, you can see jobs did fall below zero. They got down to a -1%, -0.5% year-over-year decline. And so, but what didn't happen is oil did not stay low for more than 3 years. Oil was only down for 29 months. So one of our caveats didn't happen. The recovery only was 29 months. Jobs did go below zero, but the housing market didn't decline. It looked like, I mean, it was pretty robust the whole time. It went from, oil went from 35 and recovered back to 35 within 3 years. So not a big scare there really for the industry. Now 2014, 2015, this is our most recent one. You can see oil has gone down from 105 to we're hovering around 40 now. And jobs have still not gotten below zero. We're still around 0.5%. So housing hasn't experienced a decline. We're still good, but that doesn't mean it won't happen. Companies are still kind of laying off, and we'll see what happens in the next 6 months. But as you can see from so that's what I guess I thought was the next slide. It's not. So right now it's just kind of a big question mark. Will it happen? So we'll get into my summary of findings. So a decline in the housing market will occur if the price of oil declines by more than 25%, and it doesn't recover in 3 years, and the job market in Houston contracts. So if year-over-year employment growth is below zero. And, obviously number 3 is kind of caused by 1 and 2, but I'd say it's the kind of the last straw where, yep, we're about to have a housing decline. So the yellow highlights are the 3 out of the last 5 that we looked at. 3 of them had housing declines, and the months recovery were all greater than 3 years. The percent decline was all more than 35%, more than 25%, actually more than 35%. And the housing decline, we had a 25% housing decline, a 19% housing decline, and a 10% housing decline. So just to get an update on what's going on in our job market now, again, this is the last trigger where before a housing decline happens. The most recent outlook was almost below zero. It's gone down from, we were having like 4 and even 5% year-over-year employment growth, but most recently we've gone all the way down to 0.3. So if I'm saying as soon as that gets below zero, you can start expecting some housing issues. So I would say in the next 12 months, I think we will go below zero on the year-over-year jobs, and I expect anywhere from 5 to 20% decline in the housing market.
I see a lot of football playing.
Yeah, and so that's a good point too. I'll show you another thing that's happened. So here we're talking about diversification of the Houston job market. So back in 1990, oil and gas, this has a little bit, it's not perfect because it doesn't tell you all the indirect jobs created by oil and gas. So like they'll split it out by direct oil and gas, how the Bureau of Labor classifies things, but they'll also have like financial and accounting. Well, some of those financial and accounting jobs are oil and gas related, right? So you have to do some kind of methodology to split it up. So how I did it shows that the oil and gas market accounts for roughly 62% of Houston's economy as far as the jobs market back in 1990. And are we more diversified now? Yes, but only slightly. The same methodology, it's down to 56%. So it's still pretty high. I think it feels like that now. It might not have felt like that 6 months ago when everything was going good, or 20 months ago when everything was going good, but it still feels like we're pretty heavily dependent on oil and gas. Part of the reason for the decline, though, is that education and health You know, we have one of the best medical centers in the world. Those jobs have increased. So we've given a little, oil and gas have given a little away to the medical field, but not much. Still dominates our economy.
I'm shocked that that's only 12%. I thought it would be more like, I don't know, 30 and 30 or something like that.
Yeah. There's a ton of oil and gas jobs in
Well, I
Houston.
mean, I know that.
Yeah.
But I also thought that there was a ton of healthcare jobs.
Right. So yeah, down at the bottom
Is
there's
that compared to that's just Houston, but not compared to the whole U.S.?
yeah, it's just Houston.
Yeah, it's just Houston, but I thought in Houston with the
Yeah.
medical center being as huge as it is.
But maybe compared to like other cities and states, that might be a bit more than others.
I just thought with Houston, with all what we have,
I mean,
it
they're
would be.
having,
I thought it would at least be 20%, but that's shocking. Okay.
Yeah, so those are in thousands down below. So there's 378,000 medical education and medical jobs.
Okay. And you said direct oil and gas or indirect oil and gas is like the accountants that work for oil and gas companies. Okay.
Yeah.
So like HR
And so
I could do
and
indirect,
construction,
or- okay.
right? Construction I considered an indirect oil and gas, right?
Okay.
A lot of those jobs are going away now because oil and gas companies aren't. There are a couple big projects that are still going on, but they're certainly not starting new projects. So that's one of the indirect categories I would attribute to oil and gas. Part of it to oil and gas and part of it to the others. Because obviously one of our friends, Nick, right, works in the medical industry, is in construction. So he would probably be part of that indirect that goes over into health. So there's no perfect way to split it up. So you have to make some methodology. So this is kind of gets to what you were talking about. I think the housing market is already kind of cooling. So the red line is year over year inventory. So as inventory goes up, of course, prices will go down. Is that right, Lily?
yep, she's agreeing with that.
Yeah, she knows.
She's agreeing. She's trying to talk over you.
Right. So year over year inventory, these are taken from HAR. HAR does a report every month. And so I looked at, the inventory of single family homes year over year, and inventory has gone up almost 35%. So that tells me we're coming toward a price decline. And so you can look, and the year over year price is the blue. It looks like it's kind of going down.
Months.
So the last thing I'll say is that you should be diversified not only in oil and gas but also in real estate. So right, a lot of times in Houston I've seen it. A lot of times people's salary, bonus, deferred compensation, their retirement portfolio, and their houses are obviously all dependent on oil and gas. Our economy is heavily weighted on oil and gas. So your real estate, your house is dependent on oil and gas too. So it's the potential for way too much concentration in one industry. And so you also got to think about, if you aren't, I've come across this as well. So if you want to stay invested in oil and gas and forget about what I warn about having too much concentration, A lot of times people will invest in the company that they're at, which obviously ramps up even more employer-specific risk. So if you just want to be, if you say that you think that you're selling low, right? If you get out of oil and gas now because prices have declined so much, why not? Why be concentrated in one single stock? Like, say you work for BP, why invest in BP stock? Why not? Because you think you're selling low. If you think oil and gas is going to go up, why not invest in an ETF that follows oil and gas companies? Why not invest in a basket of 1,000 companies instead of just your own? There's a lot of employer-specific risks that come along with just investing in one single company. Management risk, their debt risk. But no, the same amount of money you can invest in an ETF and be diversified over 1,000 companies. It's a basket of 1,000 companies instead of one. So
you can do that through the company?
No, you can do it through a custodian, Fidelity, Vanguard, Schwab, whoever you have money with. Just like an example is everyone's debt structures are different. I mean, Lynn Energy just in November was forgiven. They had to go ask for $1 billion in debt write-downs because they were about to go bankrupt. So no matter how good you think your company is, it's always better to stay diversified. You never know what can happen, and stuff can change quickly. And as far as real estate goes, a lot of times I get it asked, would I invest in rental properties in Houston? Or do you think it's a good idea to keep one home and rent out another one, buy another one, and get maybe 5? Like you're looking at the same kind of concentration. Each one of those 5 is going to be dependent on Houston's real estate market. Whereas you can invest in a REIT and you're invested in houses across the U.S., houses in Europe, houses everywhere. So you're kind of spreading that risk out.
How do you get into a REIT?
It's the same. It's an investment you can purchase.
Oh, okay.
Yeah. And so you also have the risk of tenant. You have tenant risk, of course, too, right? If I'm spreading that risk over 1,000 properties in a REIT, there's a lot less risk that if 3 people default, I'm going to default. Whereas if I had 3 people and I go 3 months without rent, that's a problem. And so you also got to think about, a lot of times people put more money towards their mortgage and they become, as a part of their net worth, their house makes up a greater portion of it. So without even realizing it, you have a greater percentage of your asset allocation in real estate. You might, if you pay off all your mortgage, you might have a $200,000 or $300,000 home and your total assets might be 500, even $1 million. Even if you have $1 million in assets, but your house is 300,000 of it, that's 30% of your assets that are in real estate. And not in just real estate, in Houston's real estate on the block that you live on. So that's to me, that's a lot of risk. That's also want to drive home that point. People think they're reducing risk by paying down their mortgage. You might be doing just the opposite. Because just like I talked about, you might have a 10 or 20% decline here in the next 24 months. That's a lot.
Yeah, but if you have a paid off house, then you need to have a place to stay. If your house,
you have a place to.
If you can't make your mortgage payment, is what I'm trying to say.
True. I'm not saying you're not getting rid of risk. I think you're replacing it with a different kind of risk that you need to be aware of. You need to consciously know you're making that decision.
Okay.
And that's it. Any questions besides the 2 graphs I need to replace, which.
So what would you suggest for people that own homes? At this point.
If you're in Houston, weather it. Generally, we looked at that page that had the summary. If you look on the far right, page 17, the recovery generally mirrors once oil comes back, you'll be fine. So it kind of depends on your individual situation. So like if you're